Hey, before we get into the Lone Star Capital podcast, I just want to mention this. If you're going to be in New York City on April 4th and would like to learn more about opportunities that we're doing, if you're a capital allocator as well as an investor, please reach out to myself and I can get you the invite to our office mixer. Additionally, if you're going to be at the Best Ever Conference in Salt Lake City, let me know. If you're a capital allocator as well as an LP investor, would love to learn more about what you're doing and how we can maybe help you. Now back to the episode. Hello and welcome back to another episode of the Lone Star Capital Podcast, episode 40, here in the Zaza Hotel in Houston, with, of course, the founder and principal of Lone Star Capital, Rob Beardsley, of course, Craig McGrother, the Director of Business Development here at the firm. How are you today?
I'm doing well. We've had a productive trip in Houston.
Yes, we have. So just to recap, Houston affairs, we had our mixer last night at Meritage Apartments, which is beautiful. Just inside of the inner loop there. It was really nice to meet some great people in person that we've corresponded with over the phone, we've done Zoom calls with, but there's just no substitute, as we've alluded to 1,000 times on this show, of in-person action, meeting people, being out there, and really cementing and or further growing relationships, whether it be with the brokers and lenders that were in attendance, some investors that we've never met before, and then also some prospective people that we got had a chance to connect with, which is always super special. Did you have any takeaways from the event specifically?
Yeah, definitely. It's always, like you said, fulfilling and valuable to get in person and get FaceTime with people and deepen those relationships. This is the year for us to go deeper rather than wider, right? Let's invest in the relationships that we have and all that. Some of the conversation was really good last night. I had a good time talking with one of our brokers that we've done a lot of transactions with. We acquired, I think, over 6 deals or so with them.
Over $100 million worth, correct?
Yeah, easily. So
he likes us.
He likes us.
Because we closed.
Because we closed, and he was singing our praises, which is always good to hear. But what was interesting to hear from him was he reiterated the fact that how he loves how we provide feedback on every single deal that they share to us, so long as it's within our buy box, right? But they're not necessarily going to go spend time sharing a deal with us that's not in our buy box because they know our buy box.
Right.
That's a interesting takeaway because to me, it's something that I take for granted, frankly, because we've been doing it for so long and we don't really think much about it. But let me just explain what this is for people who aren't familiar. Basically, when a broker sends us a deal, if it's in our buy box, we'll underwrite it, and that takes some time. We have to analyze the existing financials, revenue, expenses. We have to build a pro forma using rent comps, using pro forma expenses. We need to utilize data services like Yardi to figure out our projections. And we also need to work on getting solidified debt quotes, property tax consultation, insurance quotes. So there's a lot that goes into underwriting a deal. And most likely, 99 times out of 100, you're not going to buy that deal, right? So it's a lot of work. It's a lot of looking for that needle in a haystack. And with every deal that we underwrite like that, we underwrite it sufficiently to where we can provide a confident and actionable offer or feedback back to the broker. Brokers love feedback because brokers are nodes of data for the market. When they put a deal out to market, right, and you're familiar with this, obviously being an agent broker yourself, when you put a deal out, you need data from the market to understand how is this deal priced, what's going to happen with the trade, what's buyer sentiment. And so brokers really appreciate when we say, okay, yeah, we'll pay $120,000 per unit for this deal. And because of our reputation and relationship, they know that that's not a wild offer. That's not an offer where we're just going to tie the seller up and then look to retrade them. That's a legitimate, actionable offer. And they can take that offer to the bank. And it might not be the top offer, right? It most often isn't because we're a conservative, tactful, thoughtful buyer, right?
Can't buy everything.
Can't buy everything, exactly. But what you can do is you can offer on everything.
Correct. Which is a super interesting concept right there because you mentioned, what the bid-ask spread is, and it's great because not only do we get to provide them feedback to further enhance our relationship with one another, now the broker gets to go to their client and say, hey, good news and bad news. Good news is I got you an offer. Bad news, it's not necessarily what it to be, but at least here's some feedback and commentary from a legit and bona fide buyer who's got XYZ presence in the marketplace here. And then it also allows, them to feel more comfortable to send us deals early, and it just kind of a trickle effect that really is helpful for everything in the process, right? So super actionable that we can get that there. And then they'll give us feedback as well on the flip side if we came really close on a deal with them as to, hey, you missed it because this happened there. So those relationships, like anything, cut both ways. So providing that guidance is super beneficial, as I know, being in the residential space. And that actually extends to more deeply than one would think. And let me explain on that, because what we're looking for, even with investors, is, hey, no problem. If you didn't like this deal, why did you not like the deal? So recently I've been doing a very good job of people, or been really trying to emphasize, if someone doesn't want a deal or want to work with the deal or raise money for it, what's the reason? Is it a timing situation? Is an alignment issue? Or is it, hey, I don't like the deal because, XYZ is too aggressive, or I don't like the profile, it's not a value add, which is, something we get recently. Exactly. So it's very valuable to know what's going on there. And on our end, I'm really working to spearhead when someone says no, why are they saying no? And also, if someone's saying no every single time, what I'm really trying to get to the bottom of, is, are you actually just looking at your emails and deleting them, or not looking at them? Because if that's the case, I fully respect that. Maybe you're not someone that wants to buy in Houston, then I shouldn't be spending my time to think about you, to reach out, to send you the opportunity in the first place. Why do you want to spend a minute or two of your mental energy on that? And why do I want to send that out and have to go through the process of following up if it's just not something that we're going to mutually collaborate on at some point?
So to make an obscure reference that not everyone's going to get, but the watch fans listening will get, the way that we humbly feel about our offerings and about our company is we feel like we're offering people the opportunity to buy a Rolex Daytona Panda at retail.
Yeah.
Okay? Not everyone's going to understand that, but basically in the watch business, if you are lucky enough to have Rolex allow you to purchase a watch, you're buying it for, let's say, $15,000, but that same exact watch on the open market is worth $35,000. That is what we feel the value that we're offering. So when we have to recognize if we're not a fit for somebody, we need to not keep pounding on that door and recognize that let's go work with the people that do appreciate us and understand the value that we're offering. It's kind of a bit of a sales paradox, or just a way to orient yourself, but I think that's a healthy way, and it goes back to what we talked about earlier, which is going deeper with the relationships that are working and the people that we enjoy working with, rather than trying to make everyone a fan, which is obviously never going to be possible. And it goes back to the tropes of if you try to get everyone to like you, then no one will love you.
Yeah.
If you're okay with some people hating you, some people, you're going to get people to love you as well. Being polarizing, not to say that we're out here trying to be polarizing, but those are some of the concepts about standing out and carving your own path. Can I go back, circling back though, to the broker conversation? This topic of bidding on everything, providing feedback, being an actionable buyer where they know, okay, yeah, Lone Star didn't just throw in a random bid. They know that if they pick up the phone and call us on that offer, we'll perform. Well, all of that effort of underwriting the 99 deals to then probably only buy the one, it leads to our favorite phrase, which is hanging around the hoop. Hanging around the hoop is how we've been successful in buying many deals. And we actually use that phrase a lot, and we use it with investors. We use it in our pitch decks and our marketing material. And some people might not know what hanging around the hoop is, which is a basketball reference, right? And not that I'm a basketball expert, but it's quite simply, in basketball, if someone shoots a shot and there's a available rebound to be had, being down there by the hoop, hoping that the ball comes your way, is how you can get another shot at a point, or it's how you can maybe get a putback dunk or something like that. So being around there for when the property falls out of contract, which they don't always fall out of contract, right?
But right now, there's certainly an uptick for sure, and to that point, it's a really great time to hang around the hoop, because not everyone can raise money right now, which we'll get into. Not every group can make things make sense if treasuries move on them. People think they have equity secured, and then they find out they don't. Or maybe they were kind of halfway in, halfway out on buying the deal, and then they said, well, we don't want it anymore. So, there's a lot of that kind of going on right now, unfortunately.
That's exactly right. There's a lot of reasons why deals are not consummating, and that makes it even more attractive to spend the effort of hanging around the hoop. Because if you rewind back to when the market was super hot in 2021, around then, most deals would go under contract and they would close. And because money was widely available. So debt and equity capital were very available. So having trouble raising debt and equity to close your deal was unlikely. Number two, performance was improving so rapidly, rents were growing so rapidly. From the time of putting a deal under contract to actually getting to the closing table, the numbers look even better. So you're already happier about the deal that you're buying. It's not like in today's environment where it could be treasury volatility, now interest rates spike on you so the deal doesn't look as attractive, or we're starting to see deteriorating fundamentals, so certain pockets or certain properties are experiencing declining occupancy or declining collections. That can make it quite difficult to close, especially when you're talking about financing with agency debt, because if you fall below a 1.25 DSCR or a 90% occupancy covenant, that can make you go back to the drawing board as far as your debt is concerned. Those are some things that are happening every day in the market, which is a challenge, but it's also an opportunity because we're able to step in there and take advantage of a seller who just fell out of contract and now they're willing to go back to the market, and they look at our offer that came in low a few months ago but now is looking a lot more attractive.
And we may want to actually increase our offer ever so slightly if we're perhaps in a situation where we can increase maybe by $1 million or $500,000, which was maybe a bridge or some middle point between where the winning offer was initially and where our first offer was. So maybe we'll come up a bit if there's certainty of transaction there for sure, and to kind of meet someone at strike price where we can proceed with potentially getting into the escrow process, going from LOI to PSA to close, right? So all things to think about in this kind of treacherous point in the marketplace, which actually segues me into the next topic of conversation, which is tenured groups right now, people that have been in the business longer, have opportunities to raise equity, and based off reputation, and maybe the deals look a little bit different right now, but we kind of workshopped this topic last night, so I know you can unpack this and frame this better than I just did, so I'll allow you to do so with what was in your brain, so let it all out.
Yeah, this stems from another broker conversation I had last night. Obviously, brokers are a wealth of knowledge. It's the point that right now is the opportunity to buy great deals, but it's a much more difficult time to raise equity. For the groups that have been successful for the last decade plus, they're able to go to their investors and share a deal that they have under contract, and they say, hey, look, I know these numbers don't look amazing because of the projections of where exit cap rates are right now or the debt that we have to use, but we believe in the basis. We believe that now is a good time to buy. Are you in? And these groups are being very successful because the equity trusts the sponsor. And I'm not saying that everyone deserves that trust.
No,
right? But for those that have been successful in years past are being rewarded today for being able to be backed on much better opportunities. We can all agree that buying today is better than buying in 2021, right? I mean, we've said that over and over again. But the challenge is putting the deal together so much harder today. So it's not a given. It's not like, oh, it's so simple, just buy at the lower price today. Well, there's a lot of things that are barriers to entry in today's market as opposed to yesterday's market. So when I was having a conversation with that broker last night, he was saying how these groups today are really stealing deals, and they're able to put them together because they have investors that trust them. That's the path that we want to go down. That's the path that we're building ourselves to. It takes multiple cycles to build a track record. This business is a long, long business, right? You don't just say, oh, I've been in business for 6 months, here's my track record, right? It takes years and years to build it up, which the other point about that is the benefit of these cycles is it allows groups like us to differentiate ourselves.
for sure.
In a hot and frothy market, the groups that differentiated themselves, and I'm not saying anything negative about anyone,
No.
but the groups that differentiated themselves in the frothy market were the ones that were willing to be the most aggressive with their buying strategy, the most aggressive with their business strategy, the most aggressive with the low quality of asset they were willing to purchase, and most aggressive with their financing.
I was about to say that, yeah.
Yes, that was the winning strategy. The geniuses were the ones that took the most risk. And if you were a steady Eddie, more conservative firm, you would be looked over because look at you, you're missing out on all these major profits.
Well, I would say for some people, though, and for some groups, I think there's enough joint venture, equity group, institutional capital that kind of scoffed at the idea of what was going on before in my conversations. At least maybe now they can say that as we're out of the zeitgeist of the moment. But seemingly they were not comfortable with a lot of the structures that occurred there. And I do think it was more of boutique equity raisers, syndicators of that nature, of that vein, that may be more emerging or starting, that, were the folks who are there, and also going to be the folks that, burn really hot and cool very quickly, and maybe are going to be out of business because they can't raise money for deals coming up. Or maybe it'll be a second name or second company that these syndicators started where they have a blank track record again, if you know what I mean, right? So I do think there's a lot of that, but I do think the more sophisticated equity kind of saw right through that, and that's why a lot of people wore pencils down at one point, as we've alluded to, and hopefully you'll be a guest on the show soon. Chris Mendez said, what is risky to me was buying those deals in 2021 and 2022 with those deal profiles. It's very clear that at some point things are going to expand because this is abnormal. So that's kind of the note of this. And I think we've said this before, but it's taking Lone Star Capital and not being a commodity anymore, but a true brand, and knowing who we are, knowing what we're up to, having the conviction to move forward, having the foresight to kind of see around corners when the markets are changing or turbulent, and then also realizing opportunities at hand and how quickly they come and go with where we're right now. Remember, JC said on our show back in October, if you guys want to reference back to that episode, he's a wealth of knowledge, saying, hey, this might take, we're in the middle of it, which is in October, it might be 6 to 9 months. Well, that is in fact true. We've got about 3 months left of this buying cycle where the deals are juiciest and there's most meat on the bone right now. Now, who knows how long it will be? In our opinion, it's always a good time to be a multifamily buyer, but these blips in time, are in fact blips in time. They're very short in nature, so we really want to take advantage of these opportunities. So if you're a capital allocator or an investor, really right now is the time to prime the pump, to get ready and to deploy money into the market today. And probably for the next 24 months, it's pretty solid. If you look at historical cycles, we're probably in a great time to invest right now.
Yeah, I think the window won't be as big because I think Fed action will compress the window of opportunity, because we know that once the Fed steps in aggressively by lowering rates, investor sentiment's going to strengthen and liquidity is going to come back to the market very strongly. And once there's a ton of equity in the market, that's going to bid up pricing, right, and bid out the return premium that is currently available today. I mean, the way things are swinging wildly for Treasury volatility is really impacting when it is a good time to buy or not. Right now is quite competitive, actually. We're recording this in March, but towards the end of last year, in November, December, there were no buyers in sight. And if there was a seller that was looking to make a deal, they were not going to get a great price because there just wasn't a lot of bidding competition. So it's even just on a kind of quarter-to-quarter basis right now, things are just very choppy. I don't think we're really just kind of going on a smooth descent, find the bottom, and then smooth ascent. It's very choppy right now, and that's kind of making it difficult for everyone, us included, to find good deals. But I think we're going to transition to talking about a very interesting topic.
Yes.
Speaking of good deals.
Yeah, well, I don't know. I guess I'll lead the way, because we might have two different things.
Well, did you want to talk about affordable structures?
Yeah, well, no, we'll get to that at some point. So we're smoothly going
Okay.
back to what's going on with the market, the economy, good indicators, and rates being cut. I wanted to speak about the Pensford letter that just came out, which was very interesting. It was talking about the jobs and what's going on there. And what I found very fascinating, and I think we've spoke about this before, as of our friends, with regards to the job market and what's really going on there. And seemingly, yeah, there's a lot of job openings and such for, Taco Bell and gig-based jobs. And what the job report showed is that actually the new jobs were actually part-time jobs, and it was actually a lot of people taking up second and third jobs. So I believe that was kind of some of the subject matter there, but I would love to hear your thoughts and what your takeaway was from the Pensford letter. And by the way, if you're not reading the Pensford letter, on a weekly or whenever it comes out basis, which it's slightly sporadic.
Monday mornings, mostly.
Yeah, it can be, but sometimes he misses a couple of weeks, understandably so. It's not like he's getting paid to do it directly,
Right.
but it's really a wealth of knowledge. I really encourage you all to subscribe to the Pensford letter. It's really like the Bible for Lone Star to kind of read. I think everyone in the firm, it's almost mandated that you must read through that, at least if you're on kind of the capital market market side like we are. But be curious to know your kind of thoughts and takeaway with regards to what the most recent publishing was. I know that it'll be not the most recent when this is released, but in regards to kind of the job market, what was going on there, and kind of the indicators we're seeing in this market cycle.
It's a frustrating topic because since I subscribe to the Pensford letter and agree with what is said in there, right? JP, the author, and we agree and are just frustrated by the headlines versus what we believe the actual data to be saying. The headlines are, we have a red hot labor market, the economy is super resilient in spite of all these interest rate increases, right? And the issues I take with that are, number one, the lag effect. When rates are increased, it takes 12 to 18 months for the real economy to feel that. What does that mean? That means that we are still waiting to experience the full brunt of where rates are today. That is point number one. Point number two is you have to look under the hood about the unemployment data and the job gain data. First of all, it sounds criminal, but it's true. Pretty much every single month for the last 13 months, the headline job report comes out and says, oh my gosh, we added 300,000 jobs, it's amazing. And then a month later, the BLS, I believe, the Bureau of Labor Statistics, revises down the job growth estimate by like 120,000 jobs or 160,000 jobs. So, but the headlines go out and people run with it. And then that gets circulated in the media. And I guess, even though the bond market is very sophisticated, I guess it does trickle into the bond market, right? And if people see these headlines of super strong job growth and CPI, then they're going to sell off bonds, and that makes treasuries higher, right? And it's just a volatile thing because on a month-to-month basis, people are following what's the month-over-month trend for CPI and for job growth, because they're looking at job growth very closely, because they're looking at that as an indicator for inflation, and they're looking at that as an indicator for positive momentum in the economy. And to your point, you mentioned a couple factors that the Pensford letter pointed out, which are, okay, some of these jobs are really just a function of people adding more part-time work. So if one individual has 3 part-time jobs, that counts as 3 jobs in the market, right? It's
not net new employees kind of going back to the marketplace is kind of what I gather from that. Is that what you kind of see as well?
Yes, and I forget, he kind of, in the letter, in the weekly newsletter, he took out some factors from it, and if you look at pre-COVID versus now, we actually have, I don't know, like still 2 million less jobs or something like that. So we don't have a red hot economy, in my opinion. And going over to the inflation side of things, right, we know that inflation, the way that they calculate inflation has some fatal flaws, mainly which has to do with shelter. And it's actually unbelievably bizarre. So first off, right, the way that they survey rents, there's a 6-month lag there. We know that today rents on a national basis are going down. So that should actually cause CPI to go down. And I believe shelter, which is rent and housing costs, I believe it makes up 1/3 of CPI. And so we're still taking data from 6 months ago, and it's not factored into today. So I think there's a problem with CPI where people still think, oh, inflation is a problem right now, we need to keep rates high. I disagree, because if we look at today's data for a shelter, we see a much more decline or deflationary picture. The other point about shelter, which is the bizarre funny part, is it's comprised of rent and it's comprised of home ownership cost. Okay?
I was about to actually get to that point, so I'm happy you brought that up. You continue with your thought.
Yeah, and I believe that shelter input is 75% home ownership cost and only 25% rent cost. And the way they calculate that 75% portion home ownership cost is they call homeowners and they ask them, what would you rent your house out for? What a incomplete, imprecise, horrible way.
Moronic way to do business. And I actually think about this right now, because let's break the two.
Keep going, I'm just gonna check.
Yeah, there's 2 parts to think about there. We good?
Yep.
Cool. So there's 2 parts to think about here, right? The part number 1 I think about is with rents across the nation. I do believe wholeheartedly that rents are going to be softening in order to stay flat you name it, so probably throughout the country. Some pockets will be better than others, and some pockets are going to get really hit harder naturally, right? Nothing's linear. Different areas are doing better, of course. But what we have to think about is there is the largest creation of housing and units in recent history, I believe, that are new supply coming to the market right now that will really factor. Houston, I believe Sam Morris said the stat was about 4.8% of supply coming to Houston. Austin, Texas is 15%. 14. Okay, that's massive. And then of course Dallas is a lot of new supply, but there's new supply and development going all over the place, which only makes maybe rents won't tank, but they're gonna probably soften ever so slightly because
be flat for a couple of years.
Exactly. So it's going to take some time to absorb that. On the other side of the coin, which is homeownership and whatnot, pricing has not fallen off a cliff by any means, despite rates going really high, which obviously means that homeownership's very challenging right now. One is almost paying double the price now on their mortgage than they were about 2 years ago on the same priced house. So homeownership's incredibly expensive right now. I'm in the process of selling my house, and I'm looking around like maybe I'll buy a house coming up here moving forward at some point, but I'm looking around and thinking to myself, my payment's gonna be a little bit higher now for the same exact property. So rents are kind of softening or staying flat, and the price to own is really expensive. But why is that good for you, the apartment investor? Well, that means that there's probably not going to be a lot of homeowners or people transitioning from renting to owning here coming up in the next couple of years, which is very crucial and very, very valuable. So although we might not see a ton of bumps and spikes, there will be some stability to the rental market, just because homeownership for many people is incredibly unobtainable.
Yes, it's the widest gap ever right now.
Yeah, the value to rent right now has never felt better ever. And this is partially why I'm selling my house. I feel like I'm selling what's high and I'm going to be investing what's low and what's dislocated. The housing market is, to this point, barring a black swan event coming up between now and this being released, could not be stronger, despite rates being close to a 7% for most people across the board, insurance costs being very expensive, property taxes being more expensive, your utilities going up, and then also just think about the consumer right now. Goods are just expensive. Any way you slice it, they do not calculate inflation correctly. They have the most antiquated model, maybe purposely so, to skew the information and data. And I do know that wages are not going up as quickly, of course, as other costs. So there's a really interesting part, and I'm not as tuned in to economics as you are, but would you consider this stagflation right now? Is that what you're seeing currently? Do you think we're going to see that? Or what is your kind of overarching view and thesis with what is occurring in the marketplace right now?
Yeah, I'll definitely answer that. But speaking of wages, also the point I wanted to echo from the Pensford letter is people look at hourly earnings as a sign of inflation. If people are making $15 an hour at In-N-Out or Taco Bell, and then they're making $18 and then $20, right? That is
the minimum wage arm race.
Yeah, exactly. That is absolutely a sign of, it could be a sign of inflation. However, and that is what the data is implying right now. We've seen kind of coming out of COVID, we've seen for the first time hourly wage growth, hourly earnings. I forget the exact name of that number, but hourly earnings grow for the first time, right? Because unfortunately, for kind of the lower income, lower middle class of America since the 70s, that hourly earnings just has not kept up with inflation. So the poor have been getting poorer because we have not seen wage inflation. And not to step back and get too macro, but the reason for that has been because our population is growing. We've brought in so many immigrants, right, that are willing to work for a lower wage, right? The supply of people that are willing to work then depresses the price of that work, right, the value of that work. And so that's why we've seen a stagnant wage growth since the 70s. It's because of our population growth. Also, women have entered the workplace in a very strong way, which of course adds more supply to the workplace, which then lowers the price of those of that productivity. So
is that the gender wage gap?
That'll be another episode.
I'm kidding, yeah. That's a joke. Yeah.
So, yeah, that's after we after we made it big.
Yeah.
So that's kind of the myth about this wage growth inflation right now is the fact that yes, it is true that average hourly that's the number. Average hourly earnings is going up, but the average hours worked is going down. So business owners are compensating for rising wages by hiring people for less time. So in reality, the labor market is not booming. People aren't making more than ever. People might be making more on a dollar per hour basis, but they're working less hours.
And actually, I have a point to that, which actually brings back a thought. A lot of these big corporations like Home Depot, a Walmart, massive employers, right? What they want people to do is work 30 hours a week or 33 or 35 hours a week. Well, why might that be? Because if you work a full 40-hour week, you get a lot more benefits, health incentives, so on and so forth. So they want to manipulate it where, they can pay you a little bit more here, but they know actually on the back end that not having to pay those benefits is incredibly accretive for what they're seeking to shave their business margins, right? So it's a very interesting cross point.
Yeah, that's exactly in line with this topic. So speaking of stagflation, which people can kind of try to spook people about, look at where we're headed. I definitely don't think that is where we're headed. And stagflation, just to define that term, is an economy where you both have declining growth and inflation, which is an enigma. It's a very rare occurrence because, typically speaking, inflation is associated with a overheated economy. So there's a lot of growth, but there's also a lot of price inflation. And then when you have the economy in a recession, prices usually go down. I mean, that's the kind of the definition of a recession, right? So it's really the nastiest scenario, and we only experienced it in the 70s, at least in modern American history, stagflation. And that was a really ugly time. And honestly, the 70s, I believe the 70s, some people refer to it economically as the lost decade because of just how nasty inflation was in that decade. So I don't think that's where we're headed. I absolutely don't think that is the case because I think actually if you look at everything we've been talking about and the data projecting forward, the economy is going to be struggling with deflation, not inflation. And that immediately kills the thesis for stagflation.
Well, AI and automation is also going to be deflationary, as we've talked about before. Any technological advancement should technically be deemed as deflationary. Think about our firm now. The tools we can put in place, we don't need to have a massive workforce anymore to accomplish what we need to accomplish. We can put tools out there to implement strategies and processes to really enhance the abilities of our firm, utilizing technology. So that is beneficial for sure to think about. Another thing to think about as well when it goes to the supply conversation, which is separate and a little bit off the roads here, but we'll bring it back, of course, is, for the better or worse, we are in Texas, and for the better or worse, there is a massive illegal immigration process right now. I know that's sensitive for a lot of people. I'm not going to get into that, but it is very accretive for what we're doing because where do immigrants have to live? Definitely somewhere. So if they're in workforce housing or lower than that, that will only push up the value of maybe what would be kind of class B and C if that's kind of the lower end of what the affordability range may or may not be. So they have to live somewhere, and this is just the beauty of the investment thesis that we have, which is workforce housing, which you can't replace the replacement costs. Replacement costs on this is not viable to do, so it makes late 70s, 80s, and early 90s assets that much more appealing, especially in a state like Texas, which has legal growth, people kind of going throughout the nation into our markets, but as well as south of the border, people trickling in. So I do think that's a big benefit to the supply pipeline that we have going on currently that will counterbalance what's going on.
So if you're listening to this and you're frustrated about what's happening at our border,
invest in multifamily real estate.
You can offset your frustration by making great returns in multifamily investments.
Yeah, and I'll just be unwind the curtain here. It's a little bit concerning to see what's going on to a certain extent, but what a hedge it is where I guess maybe I'll make money off this unfortunate thing that I don't necessarily maybe believe in, but more benefit for us. I guess this is America, right? Capitalism while we have it.
We have to work with the cards that were dealt.
Correct, exactly. And I don't think you or I are be able to fix what's going on south of the border, so we might as well just try to monetize it to our best of our abilities, right? So any other thoughts you have with regards to the Pencer letter and kind of a macro economy kind of thought as it pertains to what we do specifically and what you kind of foresee going on over the next probably 6 months to 24 months perhaps?
There's always so much to talk about when it comes to economics, and I feel like it's productive, but also at the same time we end up just going around in circles and repeating ourselves a lot. So at the risk of repeating myself, I'll just say we're not claiming that today is the best time to get into the market. We're not saying that today is the bottom, but we are confident that there's a ton of value in the market right now, and we're not doing deals willy-nilly right now. That's not the type of market that we're in. Right now is the market, not necessarily to be selective. I mean, we're always selective, right? But it's just there's so few deals going on. Really, the ones that the value comes from hanging around the hoop like we talked about, and just picking up the phone or getting that phone call where, hey, this deal just fell out of contract. Are you ready to step up and make it happen? Yes, we are. We're here. We're prepared. And that's going to be a great deal. We're going to look back at those unique opportunities that we acquired in 2024 and go, wow, I wish it was 2024 again. It was a tough year, but those are some really excellent buys.
Yeah, time to grind it out. And also, this is time where, if you're in our situation where we're grinding out for equity, if you're a broker or lender grinding out for deals to make things pencil, to make through so you can feed our families and stuff, everyone remembers who they went through the mud with. Okay, everyone remembers who was there for them when the going got tough, when the market got crazy, who was there in the pocket, in the trenches, taking shots and grenades during this process, right? So we are really looking forward to really just putting ourselves more on the map as, when the market's frothy, no one's really appreciative for what they're doing. So now is the time to navigate it with excellence and precision, and to really just quadruple down on the relationships that we have, brokers, lenders, investors, equity partners, you name it. This is the time to really go through it together and come out the other side incredibly victorious. Speaking of being victorious in plans that we like to do, of course at Lone Star Capital we buy market rate deals, which for a market rate deal it's a down the fairway, simple, buy it, fix it, sell it, value add plan, or a good basis play. But there's also another strategy that we do that I just really want to harp on once more, just with how special and unique it is, which is the Texas tax abatement plans that we have in our arsenal that we're able to do. And it's funny, I was speaking with a couple of people last night at our mixer kind of regarding the opportunities that we do and the value associated. And I brought Brad over to explain. It's like, Brad, I know the downsides are, but could you let me know, what do you think the downsides are? And he had to say something, but the more he does these deals and the more he stress tests it, the more I speak with you and Kent regarding it, I am officially fully drinking the Kool-Aid and want to only do tax abatement deals if that was the opportunity. But would love to hear your perspective on the matter, and just to really extrapolate this, if you're maybe someone who's investing in Texas, to not be in kind of rent control deals, right? Because that is a lot of our people. So if you could really speak to the limited partner, the investor right now, or maybe anyone who is slightly skeptical of the program, if they're a big equity partner or capital raiser, the advantages associated with the tax abatement structure, the downside protection, because that's ultimately what you're seeking, right? We're seeking opportunities where we want to get outsized returns while putting up as little risk as possible. So we'd love to hear your perspective on the matter and things of that nature.
To address the question directly about risk and downsides of these variable or various affordable strategies, the biggest risk is the binary risk of getting approval. And that risk is a political risk, it's a structural risk, whatever you want to call it, but it's a binary risk. It could be a little bit of a discrete risk, or now I'm forgetting my terms, continuous risk, because you could get approval, but they could negotiate, whoever your counterparty is in the affordable structure could negotiate for the property to provide more affordability, or they could negotiate a bigger cut of the upside or something like that. So it's not like just, yes, they approve the deal and your property is tax exempt, or no, they don't approve the deal. It could be something in the middle, which we've actually had experience with.
Yeah, a little bit more hair, or a little bit more, I guess, formatting we have to go through to accommodate said structure depending upon where it sits in the specific submarket of the city, right?
Well, here's the deal though. This risk is a pre-closing risk. Most of these, the way that these deals are done is you go under contract with the intention of converting the property into an affordable structure and getting a tax exemption. So the risk is you're relying your business plan and your returns, your upside. What makes the deal good in most circumstances is the fact that you are placing a tax exemption on the property. So if you don't get it, that's the risk, right? The deal effectively could blow up. Well, the beauty about this type of risk for investors is they're not taking that risk, at least not with us, because when we put a property under contract with intention to go into an affordable structure, if we don't get the approval, then we're going to back out of the deal and we're going to return all the money back to investors. So the investor doesn't take any risk. So for the investor, it's really just an unbelievable super alpha strategy. And I know we've talked about alpha and beta on the show before, but for people that aren't familiar with those terms, those are investment terms that refer to what type of return you're receiving. Because anyone can invest in the stock market and make a return, but what you're most likely getting is beta. You're most likely getting a return that is a reflection of the general returns of the market. Similarly, when you invest in a multifamily syndication, most of the return that you're getting is coming by way of beta. So no matter how smart we or whoever sponsor you're investing with thinks they are and how great of a deal they think they are buying, at the end of the day, most of the return comes from beta. There's some alpha that comes from maybe you have unique supply chain and you can reduce costs, or tax exemption. That's
Property
real
management.
alpha.
Yeah, property management expertise, logistic expertise.
Economies of scale.
Correct.
There's absolutely real alpha to be had in real estate, much more so than in the stock market. It's much more accessible. And these tax exemption structures are super alpha because you can basically do very well even in spite of a bad market. It's that powerful of a structure. And again, just to reiterate the point, the downside risk is not getting approved or not getting the deal that you thought you would, but that is not a risk necessarily that investors are taking. So that kind of lays out the risk discussion. But to talk more generally about these strategies, we all at the firm love them. They're amazing because we've spent enough time with these deals. We've done 10 affordable structured deals. We've done 3 different types of structures and partnerships. We're very well versed in the affordable space, and we're actually working on our 4th structure and 11th deal that will hopefully, fingers crossed, happen later this year. That will be a super amazing outcome for our investors. Really excited about that. So more to come, hopefully more that we'll be able to share publicly and on this podcast. With all that being said, my business partner, right, the other principal of the firm, Ken Petrikowski, he's a tax attorney. He's very sophisticated. You know, we're up in New York. We've got the best team. We've got best consultants, attorneys, people that we can lean on. So we're really lucky in that regard to be able to actually wade through the complexities associated with these affordable structures.
So the next question I had for you with regards to the tax payment deals is, I would love for you to speak to investors who maybe look at this as a more of an emotional play versus logical play. And the way to answer that is to speak to the math. So please speak to the math of the matter and how accretive the program is fully.
Okay, well, I actually don't want to do that because if we speak to just how accretive it is, the public counterparts like the nonprofits and the housing authorities and the local city councils and the mayor and everything are going to come after us and say, hey, we're giving you too good of a deal. So please just keep this between ourselves. Don't go spreading around town that these are great deals for us. So it is a tricky situation, and this is the truth about alpha, because when someone really has a good deal, when someone really has a good strategy, they don't tell people about it. So we're put in a very difficult situation because we have unique value by way of these structures. But it really is to our detriment to go around town telling everyone about them. However, we have to raise money. So we have to educate and go and tell everyone about these structures and about our deals. So it's a very tough thing for us, unfortunately, that we don't just sit on a $100 million fund and we can just go to work and put these deals together. We have to be somewhat public about these structures, which is what happened to the PFC structure over the last few years in Texas, and it got so red hot and abused that they actually voted in July and changed the law of last year. So again, it's the same thing's going to happen to what we're working on. These loopholes and these structures and everything, these windows of opportunity are going to close. So yeah, that's the tricky position that we're in when it comes to wanting to educate, wanting to share more about this amazing structure, but not also wanting to blow it up.
Absolutely. Well, I'm not going to ask any more in-depth questions regarding that, but that does make me think about a point that my dear friend Paris Robbins said with regards to his business. He's in the equipment financing business, which is super niche and also not saturated at this point. He's like, I don't want anyone to know about this. I was like, you don't want to have anyone talk about what your product is. Like if you're selling something like on Instagram, you're selling garbage. Like true alpha and a truly great business model with a slight moat or lack of people in the space doing it creates a unique window and time and opportunity before other people figure out what's going on. So why the heck would you want to give up that secret? So we'll move on from that topic. But Any other final thoughts on the tax payment structure before
Yes.
we transition to the next subject that you would like to get off your chest?
Yeah, what we can talk about is just the general strategy and the risk profile, the return profile. When we do these deals, what we're doing effectively is we're restricting a portion of the property to renting only to households that make a lower amount of income for the county. And therefore we're restricting who we're renting to as well as the rent that we're charging. So the property becomes a quote unquote affordable property. Not just affordable in that the rents are low, but in our space of affordable housing, capital A affordable as they call it, it's actually programmatically affordable, right? Or tax credit, tax exempt, some sort of public benefit associated with the affordability of the property. That's a very lucrative space. That's a very niche space, just like you said with the equipment financing space. It's a niche space, and where there's not as much competition and there's more complexity, there's more value to be created. With that being said, when we do these investments, we don't have necessarily a big value add plan to go along with the strategy because it doesn't make sense. Why would we value add a property where we go in and renovate and make the property super nice if we're just going to restrict who and how much we're renting the property for? So these deals are not value add when we're doing an affordable strategy necessarily, right? There still could be some work to do, there still could be some CapEx, but it's not your typical, hey, I'm gonna go in there, renovate the kitchens and charge $100 higher rent. It's a different risk profile as well.
Wait, are we not going to paint the cabinets white?
Exactly, we might not be painting the cabinets white and doing the gray paint and everything like that, the classic renovation. So this means the risk profile is lower than your typical value add because what we're doing is all the risk is pre-closing. So actually post-closing it's a much lower risk profile deal because we're achieving our returns through an expense reduction by way of the tax exemption rather than through a revenue increase. And we know that a revenue increase is more risky than a expense decrease for a few reasons. The expense decrease is baked and it's immediate. The revenue increase, on the other hand, takes time and it's subject to the market. The market's not just going to automatically accept your rent increase. It's going to be warranted only if there's willing participants in the market that can afford it and want to pay for it. And there's a ceiling there too of affordability, right? Lowercase affordability, because generally speaking, right, you really can't max out your rent further than a third of someone's income. So I don't care how nice you renovate the property, if you're trying to ask for rents that are higher than a third of the median household income in the area, you're pushing your property above workforce housing level and above what is in that affordable, workforce housing segment, which is not typically the space that we want to play in, right? Because that's just not our thesis. We want to be in the space where people are renters by necessity, not renters by choice, and that's the segment that we feel has the most growth. So that's the risk profile of these deals where the operations are actually much lower risk than a value add deal, but the returns in many cases are just as good.
Right, which is awesome. So thank you so much for breaking that down, which brings me to the next thing I want to talk about, which is where do LP opportunities lie today? I think so much, unfortunately, for the better or worse, we're kind of speaking to other people that are kind of trying to do what we're doing or in the process of doing what we're doing, or maybe capital raising partners, which is beautiful, but what we really want to put an emphasis on is maybe the potential investor who listens to this show. So with that said, where do the opportunities lie today? Let's say if you had $1 million thrown in your pocket, where would you allocate that money if you had, let's say, a 12-month horizon to deploy that equity?
Yeah, I think we asked Sam Silverman this a few weeks ago, right? It's a great question. If I had $1 million today and I had 12 months to deploy it, I would definitely, first things first, put let's just say I would put $700,000 of it in a real estate hard money fund that would pay me somewhere between 10 to 12%. Okay. And then I would put the rest of it, the $300,000, into short-term treasury fund that would be paying around 5%.
Okay, so that means the spread there between the equity, you're probably making somewhere between 8-ish% on that $1 million, which is roughly not a bad payout.
It's
on
already
that
not
money.
bad.
Yeah,
right?
so
we're already off to a good start.
However, I just want to clarify this with the scheduling of how that money comes out from a distribution perspective. That is interest income, which in fact gets taxed as active income, which is for a lot of people not the most accretive benefit. So net long term, having money there is fine. It's good and dandy and all, but it's actually taxed not the most beneficially, as opposed to, I think at that point you're probably better off having your money in the stock market, because at least that can compound and stack and gain off one another, and you get taxed at a long-term capital gain if you hold it for a set amount of time. So it's a gap filling need. It's a short-term need, but probably not the smartest long-term play. Unless you're at a certain point in your life where you're just fine with, X, Y, Z.
Even then, it's not a good idea, because your money's not growing and it's tax inefficient. Your after-tax returns are not good. So we need to optimize not just for pre-tax returns, but for post-tax returns. But it's a great place to get started because of the liquidity profile of those two vehicles. Obviously, treasuries are one of the most liquid financial instruments in the world, if not the most liquid. So if you need your money tomorrow because a great deal pops up, boom, you can just pick up the phone with your broker and sell those treasuries and you're off to the races. Similarly, depending on which real estate hard money fund you go with and your negotiation, perhaps you can do a side letter, you can also toggle the liquidity profile of that investment as well. Some of these real estate debt funds have a 30-day liquidity, quarterly liquidity, maybe 6 month, a year, so you just want to find what makes sense for you and optimize for that. Because if we're looking at a short-term vehicle, we need it to be short-term, right? If a good deal comes up, we need to be able to send an email and be able to get those funds out of the real estate hard money fund, right, the real estate debt fund, and into the longer term investment that we want to make. So speaking of longer term investment, right, while I'm earning a roughly 8% interest in those two vehicles, I'm going to be hunting for good deals. And I know you posed the question within the framework of today, but I would say anytime affordable strategy is a good deal to do. So, and in particular, today it's great because, like we've talked about, it's a defensive strategy with still great upside potential, meaning we're not banking on rent increases to earn our return. And right now, like we just talked about, in the near term, over the next couple of years, rent increases are going to be much more difficult to achieve than before. So I'll much prefer the business plan that isn't relying on rent increases than rent increases. It's just pretty straightforward.
Yeah.
So I would be hunting for those deals, and wink, wink, nod, nod. Hopefully we have one around the corner. So if you're not in touch with us already about investing, we highly encourage that you do so.
My email.
If you want that Rolex, Daytona, Panda for retail price, let us know. Yes. But not actually, because people have reached out to us saying, hey, can you help me buy a Rolex for retail? No.
It's hard,
That's not how that works.
Yes.
So anyway, that's what I would be hunting for. Obviously, I'm a real estate guy, so I'm going to be heavily biased towards going into real estate. People like to talk about diversification, but I like to talk about diversification, because as we've seen the meme of Bill Gates and Warren Buffett on the private jet, maybe they're heading to Epstein's Island, but the meme goes, when Bill Gates met Warren Buffett, Warren told him he needs to diversify and sell his Microsoft stock, right? And so he did. And at that time, I think his Microsoft stock was worth like 80 billion or something like that. And he diversified, and today Bill Gates is doing just fine, right? He's worth, who knows, 100 billion or something like that.
Yeah, I don't want him to have any more money, frankly, so I'm happy it happens.
He's doing great.
Maybe Warren did us a solid.
If he never would have diversified and just hung on to that initial share of Microsoft stock, he'd be worth like $1 trillion, right? Because if you have a good thing, go all in on the good thing. So diversification is great to reduce risk, but it is not necessarily the greatest way to actually achieve outsized returns. So when you find something that really works for you, and it might work for you because, like for us, we're in the real estate business, we understand it, we have unique insight, so we have a better propensity to do well by investing in real estate. You and I don't know much about investing in the stock market, so why would we go into that arena and think we could do better than the market? We're much better off deploying our capital in the stock market through a beta strategy, like investing in just a passive fund, rather than trying to actively outperform the market. So that's just a little bit of a digression about diversification versus focus, but very much so believe in focus. And I would take the $1 million slowly but surely and deploy it into real estate strategies because I know it, and because of also the unbelievable tax advantages of investing in real estate. This is the craziest thing, I think. If you are a high net worth individual, if you're managing a family office, you pretty much should only invest in real estate. But see, people like to get too smart for their own good. And so if you're running a family office and you have a $100 million family that you're allocating the capital for, you're thinking, well, we need to have a private credit allocation, private equity allocation, public equity allocation, real estate allocation.
Debt, yeah.
Yeah, all sorts of stuff. And it's like, listen, you're just diversifying all these outcomes, and you're just going to go and get expensive beta everywhere. At the end of the day, the exposure between private equity, between public equities, and real estate, they're all very similar. They're all heavily correlated interest rates. They're all heavily correlated to the prosperity of the US economy. They're not that different. You're actually not diversifying. You're just simply diversifying. So instead, if you develop and then here's the thing, public equities and private equity don't have the same benefits from a tax perspective as real estate. So
Can't 1031 exchange stocks.
no. So if you are a non-tax exempt investing entity, right? So if you're not a public pension, because a pension fund doesn't pay taxes. So for them, investing in real estate doesn't make quite as much sense because they don't benefit from the post-tax return. In many cases, through real estate, your post-tax return is higher than your pre-tax return. Now, what investment vehicle can say that, right? Because if you go invest in the stock market and you make 10%, after paying taxes, you might only be left with 7%, right? In real estate, through the use of non-cash depreciation, right, through passive tax losses, if you can take that and offset other income in your portfolio, or if you're a real estate professional, you can use it to offset all forms of income in your life, you could actually achieve a post-tax return that is greater than your pre-tax return. That is really at the end of the day, that's just kind of the big flashing light that's like, hey, if you're not investing in real estate, what are you doing? The government has set it up so favorably to invest in real estate because of the tax advantages. You cannot overcome that through investing in you can't tell yourself, well, I'm going to invest in the stock market and do so well in the stock market that I'm going to make up for the lack of tax advantages. No, you're not going to be able to do that. It's just too strong. Real estate is too powerful.
Absolutely. Well, with that said, thank you so much for listening to another episode of Lone Star Capital Podcast. If you have any questions or any topics you want to go through that we haven't hit on, anything that's something that you might want us to hit, please let me know. The email, but once more, it's craig@lscre.com, and we'll catch you next time on the Lone Star Capital Podcast. Peace.